Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about GNA Axle, whether it is a buy now after a big move from March or is it an avoid. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about GNA Excel, here's a small request: kindly support me on Patreon, and once you do that, it will help me grow the channel. It will help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, a watch list of 70 stocks in which buying and selling ranges are presented, and also a number of podcasts that I put up from time to time. Now about GNA Axle, the company was established in 1993 and they manufacture rear axle shafts, spindles, and splendid shafts, components for heavy commercial vehicles, MCVs, and as well as normal commercial and you can say passenger vehicles. Have top brands like Eicher, John Deere's, and Escorts as their clients. The market cap of the company is around 500 crores. If you look at the financials, then these are the Q2 performances. The results just came out a few weeks back. Sales were down 14%, profit was flat. There's high promoter and institutional holding, but there is pledging in the stock, so you have to be careful with that regard. The return on equity is 17%, operating profit margin is around 16%, which is quite decent. So the margins are quite decent. The company is pretty good because it is a leader in these shafts and axles, but pledging is a concern, and the kind of numbers that have come in, numbers are much better for larger auto ancillary companies. If you look at the performance of the stock, then stock is down 55% from the peak of 2018 and has seen smart recovery from March low. So it has nearly doubled from March lows of 125, 130, more than doubled or nearly doubled. Valuations still look attractive because I believe that the auto ancillary space might just see a surge going forward second half of 2021, and it could be a 1.5 year surge. The management is good and strong, and things are coming back on track. There's a good dividend payout. You can say auto ancillary and autos as a space is making a bounce, and things are looking good on the ground. What were the reasons for the crash of the stock? Slowdown globally in commercial and passenger vehicle sales. So the demand for these kind of vehicles, especially commercial vehicles, reduced sharply over the last 3 years. I'm not talking of the last 6 8 months, but over the last 3 years it reduced sharply because of the global economic slowdown. So there was very less infrastructure, very less you can say government spending across the globe, especially in North America, etc., because people were suffering and economies were suffering badly. And then we ended up with this pandemic in which the situation got even worse. So shutdown of physical markets have hurt badly some of the manufacturing sector, and auto ancillary is a prime, you can say, a prime candidate for suffering a lot because of it. Domestic auto numbers were also not great, so it kept plummeting from 2018 and got down drastically. So if you remember that Maruti had zero sales for April, and many of the companies in April had virtually no sales, and that has really hurt the FY21 numbers for many auto ancillaries. You need to understand that auto ancillaries are are not quite the ones who can manage prices well, or who have the price leadership. These companies go by what the larger OEMs do, and the OEMs were suffering for the last 6 8 months here in India and abroad. There was a mid cap slam down for the last 3 years, so we have seen that small caps were out of favor since January 2018, and now things are coming back into limelight. So that has to be taken into consideration, that probably the rally is here to stay for at least the next 6 months, because the rally in mid and small cap has just begun, and sector went totally out of you can say favor. So over the last 2 years, nobody was looking at auto ancillary. People were looking at defensive sectors, at first it was consumer or FMCG, then pharma, then IT, etc., rather than looking at chemicals, rather than looking at something like autos or infrastructure, etc. But revival is expected over time. I believe next 6 8 months could be the time where there'll be more restructuring and better, you can say, numbers coming in from the auto space, and the stocks will perform. Now, if you look at the technicals, then 52-week low of the company was around 126. 210 is a very strong support, and that was the low made in 2018 if we take that out. But 126, 130 has been a very strong low. Strong support between 240, 260 level, and that is where currently the stock is trading at. The 200 DMA is around 275. Once it takes out 280, 285, then the big surge will begin. Currently the stock is at around 255. So probably, technically speaking, wait for that move above 280, 285, then take a stop at 250 and take a trade like that. Right now I believe that long term players are accumulating. Those who want to hold the stock for 3 4 years are accumulating for greater returns, maybe a doubler or like that. And strong DII and promoter holding is in the stock, so that is a strong positive for the company. So what needs to be done? In my opinion, if you have money on the side and you can spend it for the next 4 years, just put money for the next 4 years. I think these are good times to get into auto ancillary. GNA Axle is one of the leaders in its space of axles, etc. So yes, it is a small and micro cap, but it is a leader in one space. So you can go ahead and buy it with a relative stop loss in place, that whatever stop loss that you're comfortable with, be it 15 20% from the level you buy. And turnaround in sector is expected over the next 6 months. I would say 6 8 months, not 12 months, but in the next 6 months I expect things to really get better, because the vaccine part could be out by June July here in India. So by the end of the year, yes, in the next 12 months things could be very different from what it is today, and numbers could really kick in from the second half of FY22 and in FY23. So have a 3 year, at least a 3 year time frame with the stock if you want to invest in such businesses, and just stay put. If you're not worried about your investment going down 15 20 25% from your buying price, you can go ahead and buy it as a risky play. Otherwise, look at larger auto plays or larger companies rather than companies with less than 2000 3000 crore market cap, sort of things. Do not invest more than 5% of your total holding, and this sector may test your patience. So it won't be that, okay, today I've said and it looks like next 6 months, after 6 months things will get better. It could be that we could be in trouble and it will take at least 18 months, and that's why you should have a 3 to 4 year time frame with these companies, and then you'll reap rewards earlier than 3 4 years. So that's my strategy while saying that you should have a 3 4 year time frame while buying into such stock. So this was my video on GNA Axle. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.